Welcome guys, Belina Morake again. So today we are at the end of our chapter. We are focusing on profit reconciliation. So as we've been working on example 11.1, today we wrap up everything. So we are looking at the standard cost that has been set for the selling price at 88 Rand per unit. The standard cost per unit is 77 Rand, which is made of the material cost for material wood and material willow, direct labor, variable overheads, as well as the fixed overheads. So selling price minus our standard cost per unit then gives us our standard profit, which is 11 Rand. Then the budgeted income statement was at 8,000 units. That gave us a profit of 88,000 Rand. Then what actually happened now was that 9,000 units were manufactured and sold, and they were sold at 92 Rand per unit. So our profit came to 828,000, less the cost of sales of 740,100. That then leaves us with a gross profit of 87,900. So we are now going to reconcile the profit with our actual information. So reconciliation statement, remember that it represents a summary of the variances for the responsible cost center. So we are going to take into account all the variances that we have calculated, starting with the material price, going to the labor, going to the variable overheads and the fixed overheads, as well as our sales variances. A reconciliation can be done using both absorption costing or the marginal costing principles. You'll remember that when we did the fixed overheads, we separated from the absorption to the marginal costing. So when you do your reconciliation statement, you also have to check as to which system that the company is following. If they're following the absorption costing, it's going to include more of the fixed overheads variances than with the marginal costing. So we already did the calculation of our variances, so we're just going to go to the profit. The profit will then come to 88,000. Where are we getting this from? From our budgeted income statement. And then we're going to now add the sales volume variance. We calculated the sales volume variance and we got a variance of 11,000, which was favorable. So 11,000 added with the 88,000 then gives us a standard profit of 99,000. Then you're going to add favorable variance if at the end it's favorable. If they're unfavorable, then we're going to subtract. So we will start with the sales price variance. When we calculated our sales price variance, we had a favorable variance of 36,000. We also calculated our material price variance. Material, we had material wood and material willow. Material wood gave us a 10,100 adverse variance, and material willow gave us 19,000 favorable variance. So 10,000 minus plus 19,000 then leaves us with 8,900, which will be a favorable material price variance. Then we also did the material usage. We have material wood as well as material willow. Calculating the material usage for wood gave us 16,500, which was unfavorable or adverse, and willow gave us 10,000, which is unfavorable or adverse. So 10,000 plus 16,000 gives us a total of 26,500, which is unfavorable for material usage. The labor rate, when you calculated it, we got 28,500, which is unfavorable. The labor efficiency also 12,000, unfavorable. Variable overheads rate gave us 6,000, which was favorable. Variable overheads efficiency 3,000, unfavorable. Fixed overheads expenditure 4,000, unfavorable. Fixed overheads volume variance favorable 12,000. So what you're going to do now, starting with your sales price variance, that 36,000 favorable. Remember, favorable means it's a positive amount, and unfavorable or adverse, it's a negative amount. So you will then add all your favorable variances and subtract your unfavorable or adverse variances. When you perform that in this example, you will end up with a final answer, which is 11,100. In this case, it is unfavorable or adverse. So that will be the 11,100 where we said add or less favorable or unfavorable variance. That amount you will then subtract it from the 99,000, which will then give us a profit of 87,900. It has to come to the actual profit because remember, what actually happened was we sold 9,000 units, and in the selling of the 9,000 units, the profit then came to 87,900. So now we reconcile what we had in our budget, which was for the 8,000 units, to get to the actual profit of the 87,900. And this is done using the absorption costing. Remember again, there is a difference as to how you do absorption costing as well as the marginal costing. But at the end of the day, the profit remains 87,900. So all the amount for the variances, you will then get them from your calculations when you were calculating the variances separately. And then you're still going to look at 11.1, but now as to how will we reconcile our profit if we were to follow a marginal costing system. So this is the formula, this is the solution as to how it will look. The budgeted profit will still be 88,000. And then under the marginal costing now, the sales volume variance came to 23,000, which was favorable. So 88,000 budgeted profit plus 23,000 volume variance under the marginal costing then leaves us with a standard profit of 111,000. And then we are going to add all the favorable variance or subtract the unfavorable. Firstly, our sales price variance, it's 36,000 favorable. The material price variance, 8,900 favorable. Remember, it is inclusive of the material wood as well as willow. The material usage variance as well, 26,500 for material wood and willow. The labor rate, 28,500 adverse. The labor efficiency, 12,000 adverse. The variable overhead rate, 6,000 favorable. Variable overhead efficiency, 3,000 adverse. And then the fixed overhead expenditure comes to 4,000 unfavorable or adverse. So when you add the favorable and minus the unfavorable, that leaves with an unfavorable variance of 23,100. The 23,100 will then be subtracted from our standard profit of 111,000, which will then leave us with the actual profit of 87,900. If your calculation does not come to the actual profit, it means you have made a mistake in your calculations. So you'll have to go back and check yourself. At times will be you have said a variance is favorable when it's supposed to be unfavorable. So please, as you're calculating your variances, take extra care that you're putting all the amounts correctly in your calculator and checking that everything is supposed to be favorable or unfavorable. That will help you to save some time when you get to the reconciliation. Continue the reconciliation. We have to report on the variances. Variances should be reported after every control period. If the variance reported after the control period, then there might be a chance that the information is out of date. So once you are done with your calculations and everything, if it's the report period, please make sure that you do the reporting. Variance reports which contains a reconciliation of budgeted and actual profit can be sent to the senior management or to individual management where the report contains information on their particular aspect of operation. This will then help them to realize where they have made a mistake and take some corrective measures. It will also help them realize where they have done well, and then they can keep up doing their good work. But remember, every report is important as long as it is received when it is still worth it. The interrelationship of variance. A favorable variance is in one area of the organization may be interrelated with favorable variance elsewhere and vice versa. A favorable material price variance that is due to purchasing a cheaper material may result in an unfavorable material usage variance, as there may be more material wasted. This may also cause an unfavorable labor efficiency variance due to an increase in labor time spent on working with the cheaper quality of material. The sales price and volume may be interrelated, as an increase in sales price may result in decrease in the units sold. Therefore, a favorable sales price variance may result in an unfavorable sales volume variance. Alternatively, a reduction in the selling price adverse sales price variance may cause a higher sales demand from customers. Favorable sales volume variance. Use of unskilled labor may account for a favorable labor rate variance, which in effect may result in an unfavorable labor efficiency variance, as there may be an initial learning effect. On the other hand, using more expensive, experienced labor to do work may cause the labor rate variance to be adverse, but may increase productivity, resulting in a favorable labor efficiency variance. A favorable or unfavorable labor efficiency variance also accounts for a favorable or adverse overheads efficiency variance when overheads are absorbed on labor hour basis. An adverse material mix due to a more expensive mix of material may result in higher output levels and favorable yield variance. Thank you. That will be where we are ending with our standard costing. Thank you.